Hi, it's Leo Namiot, Mortgage Loan Officer. You can reach me at leolens.com or 904-712-1500. So I get this question all the time. I've been in this business over 23 years, and a lot of times people don't understand what is debt to income and what does that mean? What does the debt to income ratio mean? Why is there a low number and why is there a high number? So there's a front end and a back end. And I'm going to explain it to you and show you how you can easily calculate your own if you're out thinking about buying a house or you're house shopping and you're trying to figure out where the numbers are. So you're going to go to leolens.com, scroll to the bottom here where you will see the calculator. It's real easy to figure out. So let's just say your income here was $7,900 a month. Let's say your monthly debt, and let me explain monthly debt. Monthly debt doesn't mean if you owe the credit card $5,000 that you put $5,000 here. It means if you owe the credit card $5,000 and it says your minimum, that's the key here, minimum monthly payment is $120, then you put $120. Let's say you had a car payment, even though you might owe $12,000, your payment per month is $240, so you're going to add that on as well. So instead of $120, you're going to have $360 in this box. So you just go ahead and add your monthly payments. So for this example, I'm going to use that you are obligated to pay. On your credit report, it's showing that you're obligated to pay, say, $600 a month total. So we put that there. Let's say the house price is $300,000. We're going to use conventional here, and we're going to assume you put 20% down. You could put far less, but we're going to use this for this example. 20%. It's going to give you a loan amount of $240, 30-year term. And I'm going to use the interest rates where we are right now as I'm doing this on February 5th, 2026. This is where I am right now. 6.125. Credit scores at this point don't really matter. What a credit score means is when we plug in your actual credit score, you will get an interest rate based on where your scores are. The better the credit score, the lower the rates. So this is going to change. So if I plug this in right now at a 620 score, this 6.125 for a conventional loan would not be available. That's with somebody with really good credit, like 760 or above. If you were below, and you were like 700, that might be a little bit more. If you're below, say in the 640, 650, it's going to be even higher. So it changes a lot, especially with conventional mortgages. So that's something to keep in mind. FHA, VA, government loans are a little bit more lenient. Rates are usually better, and they're usually a little more forgiving on the credit score. And they also usually are higher on the debt to income ratio allowances. So let's continue and let me show you how this works. So we're going to skip the credit score because that doesn't matter right now. Property taxes here in Florida, 1.25 is about the average. So I use that percentage. You really have to get actual numbers as listed on the city records so you know what that number is. But for now, I'm going to use that number. Homeowners insurance, you're going to have to shop for that. That's something you pay up front when you're closing, and then it's escrowed in typically into your mortgage going forward. All right, so the next thing is PMI. There is no PMI if you put 20% down on a conventional mortgage. And let's say your homeowners association dues, if you're buying in a community or maybe a condo or a townhouse that requires HOA fees monthly, while we don't collect these as a lender, we need to plug this number in because this is an ongoing debt. So be very careful when you're shopping because these HOA fees go from very low to very expensive. For example, where I live, I think we pay $50 or $60 a month. Where a friend of mine lives, he pays, I think, $550 a month. So you have to really be careful, especially in condominiums. A lot of them have high HOA fees, but they include a lot of stuff. So just be careful because we do have to include that in the monthly debt, even though we don't collect it. It's still a monthly obligation. So you're going to see a summary here based on everything I just plugged in. And it's going to tell you what your total payment would be based on everything we plugged in. 20% down, debt to income ratio 25.26 front end and 32.86 back end. And I'll explain to you how that works. So again, here's your breakdown right here, the payment breakdown. It's going to break everything down for you. Here's the monthly payment, loan amount, and your debt to income ratio. So what is front end versus back end, and what does that mean? So typically on a conventional loan, it will go to a back end of 45%. Sometimes you can squeeze a little bit more out of it. Sometimes it won't even go that high depending on what your credit profile is, how much your money you're putting down, how much you have for reserves. So that's all determined once we go ahead and run desktop underwriting and come back with the findings. I've had them come above 45%, and I've had them where they wouldn't approve it for under for 45%. They want under 45%. So that all depends on the overall credit profile, but typically 45% is a common thing. When you're looking at government loans, I've had them approve at 50%. I also had them approve a little over 50% because they were a strong candidate to buy a house. They had great credit scores. They have assets. They might have been putting money down. So sometimes you could squeeze a little bit higher, but typically 50 is probably the top number that you're going to get on most loans. And there's no guarantee. It just all depends on your credit profile and what desktop underwriting comes back with. And that means we are sending all this information through an electronic review, and it comes back and lets us know if it's eligible for a loan or not based on your total credit profile, the amount of money you're putting down, your assets, how long you've been working at your job. All that stuff is taken into consideration through desktop underwriting. So how does this work? What is your debt to income ratio? 45.26. That means if you had no debt at all, let's say that I erase this monthly debt at 600 and I update it, it's even 25, 26, 25, 26. That means you had no debt at all. All you have is your mortgage payment. Now, if we added in debt of $1,000, you'll see the back end will change, 37.92 now. So that means your total debt to income ratio in this scenario is 37.92. Let's say you had, let's go to $1,500. So we plug this in, now you're at 44.25. Let's just say, for example, you had $2,500. Let's see where that goes. Now you're way over. While you still have a front end of 25, 26, which is great, you don't have the back end, meaning total debt, including your mortgage, your HOA fee, if you have one, all your taxes, insurance, plus the monthly minimum obligations. Again, that doesn't mean the balance. It means what your total debt is per month based on minimum payments showing up on a credit report. All right, so let's back this down to $1,400 for a minute. And again, it's going to show you, here's your front end and there's your back end. So the total back end in this case looks great because it's under the 45%. Again, it doesn't mean that you're going to not get a loan because you went over the 45%. It all depends on the credit profile. So if we put this at 1,600, we're past 45, doesn't mean, oh, I don't qualify. Let's run it. Let's see, we come back with findings. And then we can look at a way that maybe possibly get that into a range where it actually works for the findings. So hope this explains everything for you. It's real easy to do. So if you're shopping for a house or you're thinking about buying a house, and you can go here and change different loans. You could go to an FHA loan, a VA loan, USD loan, or excuse me, USDA loan, jumbo, and you can put the numbers in here and you're going to get some kind of a breakdown and let you know where you're at. So any questions, feel free to reach out at any time. Hope this is helpful for you.